Hello, I'm Thomas Taplin, and as the weekend dawns on us, it's time to have a look back at some of the key events to have affected the markets in the last week. On the line for comment is James Nixon, Chief European Economist at Societe Generale in London. Let's start with Japan, James. So the BOJ decided to go ahead with its 2% inflation target and offered open-ended asset purchases by 2014. Japan recently posted a record deficit of about $78 billion for 2012. Are these measures enough?
Well, I think the issue is whether they're going to be enacted in full. And the interesting thing really is having set essentially the BOJ a 2% inflation target. What we saw last week was the BOJ actually published their latest set of inflation forecasts, which suggests that even in 2 years from now, inflation is only going to be expected to be 0.9. So I think there's still a sort of a sense of tension, or at least a gap between, if you like, what's being desired on the policy side from the politicians, and if you like, from the implementation from the central bank. So that's something that is, I think, still very much in a state of flux, and we expect to see that resolved probably in the coming months. What will change, of course, in April is Chicago will effectively be replaced when he stands down, and so will two of his deputies. And I think what that will do is, on the 9-member BOJ board, is you'll then see, I think, a majority who are much more in favour of, shall we say, perhaps breaking away from some of the what has traditionally been a very conservative stance from the BOJ, and are more inclined to adopt, shall we say, Western-style sort of quantitative easing and these sort of open-ended purchase programs, perhaps with more determination. So really, I think it's that period in April that's going to prove to be the decisive shift from the BOJ.
We also had a meeting this week of the Eurogroup and ECOFIN, as well as a new chairman being decided for the Eurogroup. Most of us this week were watching out for any further ESM-related announcement on the recapitalisation of banks. Did we get that?
No, is the short answer. I think this sort of underscores what is a sort of very pertinent problem for Europe at the moment. In that, we're in an environment in which we're seeing effectively the success of the ECB's OMT announcement, and that's gone a long way to easing some of the financial market tensions in the euro area. But that's been bought at the price of significant moral hazard, primarily in the sense that the drive from the political side to continue the reform agenda, as you say, to continue resolving this issue on whether the ESM will be able to recapitalise banks. The progress in that direction seems to have largely become quite stilted, if not sort of stopped completely. And certainly, I think what we see on this particular issue of the recapitalisation is really a desire from perhaps some of the northern European countries, particularly Germany, effectively to sort of push this topic far enough into the future as to almost be no longer relevant. The ESM will effectively be able to recapitalise European banks when it's no longer necessary.
Finally, just touching on US data out this week, we saw a decline in US weekly jobs claims, the lowest for 5 years in fact. What are your thoughts on this?
Well, the US is slowly regaining some traction. The sense I think we have is the US is relatively well positioned. It's showing signs of an economy that's healing. So you can point to the fact that it's at the fairly late stages of a typical cycle in capital goods. You see that most clearly in an improving housing market. It's also the case, I think you can point to significant efforts to deleveraging in the households and the corporate sector. So what's been holding the US back a bit has really been all the uncertainty surrounding the fiscal cliff. And really, I think the thing is that over the last couple of weeks, what we have seen is the cliff. Perhaps not completely resolved, but more sort of broken down into a series of steps. Some of them baby steps, some of them bigger. Even yesterday, for example, we've obviously seen the debt ceiling essentially pushed out till May, and we've seen Congress vote for an attempt basically reinstituting a normal budget process and getting away from this process where essentially the US government is funded by continuing resolutions. So all those things are very positive in terms of making positive noises on actually striking a deal on the fiscal cliff. And essentially that reduction in uncertainty is feeding through into the economy, and I think that's what's being reflected in some of the jobless numbers, that it's allowing the economy to pick up steam. And I think we are on course for what will potentially be an above-trend quarters growth in Q1. Obviously, the concern going forward is that despite the positive noises from Congress, it continues to be the case that I think politically the two sides are still very far apart. And there is, nobody should underestimate that there is still an enormous amount of work to do to actually hammer out a budget agreement. So that's very much one that we continue to watch.
Okay, thanks for joining me. That just about wraps it up for this week. Before I go, though, I'll leave you with one of our quotes of the week by Daniel Murray, who is the chief economist at EFG Asset Management. He says, if we were to have the referendum tomorrow, the vote would be in support of Britain leaving the EU. But there's an awful lot of water to go under the bridge before that vote takes place. I'll be back on Monday with a look at some emerging market currency pairs. But until then, have a great weekend. Goodbye.